Hello students, welcome. This is Dr. Chetna Kumavat. In today's lecture, we will understand financial leverage. Financial leverage is related to financing activities of the firm. From the point of view of cost or charges, a firm can raise finance from the sources which carry fixed financial cost and which do not involve any fixed cost. Financial leverage arises from the presence of fixed financial cost in the income stream of the firm or due to the presence of fixed return securities in the capital structure of the company. Fixed cost or charges securities are debentures and preference shares. The rate of interest on debt is fixed and has to be paid irrespective of the amount of earnings. The rate of dividend on preference shares is also fixed, though preference dividend is paid when the company earns profits. The rate of dividend on equity share is not fixed, and the residual earning after interest, tax, and preference dividend belong to equity share holders. When the rate of company's earnings is higher than the rate of interest and preference dividend, there is an increase in earning per equity share. The impact of fixed cost securities on the earning per share is the result of financial leverage. Thus, financial leverage is defined as the firm's ability to use fixed financial charges or cost to magnify the effect of changes in earning before interest and tax on firm's earning per share. In other words, the principle of financial leverage analyzes the effects of change in EBIT on firm's EPS due to the use of fixed cost bearing sources of capital in its capital structure. The financial leverage is sometimes termed as trading on equity, but most of the authors on financial management are of the opinion that the term trading on equity should be used only when the financial leverage is favorable. Financial leverage may be favorable and unfavorable. If the earnings made by the use of fixed interest bearing securities is more than their fixed cost, the firm is considered to have favorable financial leverage or trading on equity. If the firm earns less than the cost of borrowed funds, the firm is said to have an unfavorable financial leverage. Now let's understand the effects of financial leverage. Financial leverage has two types of effects. Number one, effect on shareholders' earnings, and number two, effect on financial risk of the firm. First, we will understand effect on shareholders' earnings. The effect of financial leverage on return to equity shareholders or shareholders' earnings depends upon the relationship between earnings before interest and tax, which is EBIT, on the one hand, and the amount of interest charges and fixed preference dividend on the other. In other words, the effect of financial leverage on the return to equity shareholders depends upon the extent to which fixed financial costs are covered by the rate of earnings. A company's rate of earnings is higher than the rate of fixed charges. Financial leverage has a favorable or positive effect on EPS. The excess of earnings generated by the use of fixed cost funds after meeting the cost of such funds, which is interest, helps to increase the EPS or return to equity shareholders. Let's take an example. If a company obtains a debt at 10% rate of interest and earns 15% on the assets financed by such debts, then there will be an increase of 5%, which is 15 minus 10%, in EPS, which is earning per share, after paying the interest on debt. On the other hand, if the firm earns only 8% on the investment of such debt, the EPS, which is earning per share, will decrease by 2%, which is 10 minus 8. Thus, financial leverage is a double-edged sword where it has the potential of increasing as well as reducing the earnings or return to equity shareholders. Number 2. Effects on financial risk. With the presence of financial leverage, the percentage change in earnings per share is more than the percentage change in operating profits. For example, if 10% increase in operating profits results in 20% increase in EPS, then a 10% decrease in operating profits will result in a decrease of 20% in EPS. Thus, with the use of financial leverage, financial risk increases. Financial risk means the firm's inability to cover the fixed financial costs. When the firm fails to meet its obligations, which is payment of interest, year after year, its creditors may demand compulsory winding up of the company. Thus, the more is the proportion of debt in a firm's capital structure, the greater would be the financial risk to the business. Therefore, it is said that debt is like a fat, which is good for a healthy person but dangerous for a person with high blood pressure. So while using it, the debt absorbing and debt paying capacity of the firm must be kept in view. Now let's understand the computation of financial leverage. At single level of profit, the financial leverage may be calculated by using the following formula, which is operating profits or earnings before interest and tax divided by earning before tax but after interest, or we can say EBIT divided by EBT or EBIT divided by EBIT minus I. Here I stands for interest and EBIT stands for earning before interest and tax. The next point is degree of financial leverage. The degree of financial leverage can be measured in any of the two ways. The degree of financial leverage can be measured by the percentage change in earnings per share in relation to percentage change in earnings before interest and tax. Accordingly, the formula would be as percentage change in EPS upon percentage change in EBIT. Degree of financial leverage may be defined as the percentage change in taxable profits as a result of percentage change in operating profits. Accordingly, the formula can be put as under percentage change in taxable profits divided by percentage change in operating profits, or we can say percentage change in EBT divided by percentage change in EBIT. The quotient should be greater than 1. If the quotient does not exceed 1, there will be no financial leverage. When only one level of profits is given in the question, the degree of financial leverage can also be calculated by the following formula, which is EBIT upon EBT. When two levels of profits are given, the financial leverage and degree of financial leverage are equal. But degree of financial leverage is meant for present level of profits and not for the changed or assumed sales level. Now let's come to the point characteristics of financial leverage. From the foregoing description, the following characteristics of financial leverage have been identified. Number 1, related to liability side of balance sheet. As operating leverage concerns with asset side of the balance sheet, similarly, financial leverage concerns with liability side of the balance sheet, where various types of sources of capital are shown. Number 2, mix of methods of financing. Financial leverage determines the mix of various methods of financing necessary assets. In other words, what are the different sources of raising total capital required so that the return to shareholders may be maximized. Number 3, effects on EPS. Financial leverage shows the effects of changes in operating profits on earnings per share due to fixed financial charges. And lastly, financial risk. Financial leverage involves the financial risk, that is, the risk of failure to cover the fixed financial costs of the company. When the rate of earnings is less than the rate of interest or preference dividend, the use of that, which is financial leverage, can result into loss to the equity shareholders. And if the earnings are continuously insufficient to cover the fixed financial costs, it is not possible to pay the interest charges year after year, then there is a risk of insolvency and the creditors may demand compulsory winding up of the company. Now let's come to the point, which is utility of financial leverage. Capital structure planning. Most of the firms have mix of debt and equity. Since financial leverage is concerned with indigenous balance between debt and equity capital, hence an optimal capital structure may be determined where cost of capital would be minimum and the return to equity shareholders maximum. Profit planning. Financial leverage affects earnings per share or earnings before interest and tax. Therefore, the concept of financial leverage is important for profit planning. Profit planning requires careful analysis of various possible levels of sales and the resultant profitability. One of the tools frequent use in profit planning is break-even analysis, and break-even analysis is used in understanding the concept of financial leverage. It may therefore be said that concept of financial leverage is quite important in profit planning. And lastly, increase in shareholders' income. More dividends can be declared in case of favorable financial leverage. This will increase the goodwill of the firm, resulting in an increase in the market value of its shares. The increased goodwill will help the firm in obtaining loans at low level of interest. Let's quickly understand the relationship between operating and financial leverage. There is a close relationship between operating leverage and financial leverage. Operating leverage is concerned with investment or acquisition of assets decisions, while financial leverage is associated with financing capital structure decisions. The financial leverage represents the relationship between operating profits and return or equity, whereas the operating leverage denotes the relationship between operating profits and sales revenue. Operating leverage influences earning before interest and tax, while financial leverage affects earnings after interest and tax. When a firm uses both the leverages, their combined effect on the shareholders' return and risk may be called total leverage. In such a situation, even a minor changes in sales volume will create wide fluctuations in earnings per share or the rate of return on equity. Both the leverages are used to magnify the return to the owners, but increasing use of leverage leads to operating and financial risk or increases the uncertainty of return. Financial leverage begins where operating leverage ends. That is why operating leverage and financial leverage have been described as first stage leverage and second stage leverage respectively. In brief, the difference between the two leverages have been explained as follows. Objective. Operating leverage magnifies effects of changes in sales volume on operating profits, whereas financial leverage magnifies the effects of changes in operating profits on EPS. Relationship. Operating leverage establishes a relationship between operating profits and sales, whereas financial leverage establishes relationship between operating profits and return on equity. Measurement. Operating leverage measures a firm's ability to use fixed cost assets to magnify the operating profits, whereas financial leverage measures a firm's ability to use fixed cost funds to magnify the return to equity shareholder. Operating leverage relates to asset side of the balance sheet, whereas financial leverage relates to the liability side of balance sheet. Effects on income. Operating leverage determines income from operating activities of the firm and affects profit before interest and tax, whereas financial leverage determines division of operating profits between creditors and shareholders and affects profits after interest and tax. Risk. Operating leverage involves operating risk of being unable to cover fixed operating cost, whereas financial leverage involves financial risk being unable to cover fixed financial cost, that is interest and dividend on preference share capital. Decision. Operating leverage is concerned with investment decision, whereas financial leverage concerned with financing decision or capital structure decision. Lastly, operating leverage are called first stage leverage, whereas financial leverage are called second stage leverage, as financial leverage starts where operating leverage ends. So this was the relationship, or we can say differences between the two leverages. Lastly, we have one point, which is combined or composite leverage. As explained earlier, operating leverage affects business risk and measures percentage change in operating profits due to percentage change in sales. On the other hand, financial leverage affects financial risk and measures percentage change in taxable profits. Thus, both these leverages are closely concerned with the firm's ability to recover its fixed costs, both operating and financial. Thus, operating and financial leverages are combined to asset the impact of all types of fixed costs. In case both the leverages are combined, the result obtained will disclose the effects of changes in sales over changes in taxable profits, or we can say EPS. As such, the combined leverage may be defined as the relationship between contribution, which is sales minus variable cost, and the taxable income. The combined leverage can be computed by multiplying operating leverage and financial leverage by way of formula as given. Further, contribution divided by EBIT multiplied by EBIT divided by EBT, or we can say contribution divided by EBT, and also operating leverage multiplied by financial leverage. So this is it with this today's lecture. Thank you so much for your patience and learning.